$63 trillion. That is the size of the monster breathing down your neck right now. That is not a typo, and it is certainly not a rounding error. That is nearly half of the entire world's financial assets sitting in the hands of lenders who have almost zero supervision, zero transparency, and absolutely zero obligation to tell you when they are about to blow up the global economy. You thought the Great Recession was the end of the story? You thought 2008 was the grand finale where the bad guys lost, the good guys passed some strict laws, and we all went back to safe, boring banking? Oh, you sweet summer child. You have been sold a bill of goods so fraudulent it makes a Ponzi scheme look like a charity drive. 2008 wasn't an ending. It was an origin story. When the government finally decided to crack down on the big banks, your Chases, your Citis, your Bank of Americas, they didn't kill the greed. They just made it inconvenient. And capital is like water. If you block it here, it flows there. The risk didn't vanish into the ether just because some politicians patted themselves on the back for signing the Dodd-Frank Act. It simply packed its bags, walked out the front door of Wall Street, and moved into the house next door, a dark, windowless fortress known as the shadow banking system. These aren't banks in the way you understand the word. They don't take deposits, they don't have federal insurance, and they don't have a regulator looking over their shoulder. They are unregulated financial cowboys playing with leverage that would make a 2007 Lehman Brothers executive blush. And the terrifying part? They are now the ones lending money to the companies you work for, the hospitals you visit, and the landlords who just raised your rent. The fuse has been lit for over a decade, burning quietly in the dark. And while you're worrying about the price of eggs, the shadow banks are holding a grenade with the pin pulled out, waiting for the exact wrong moment to drop it. Let's talk about the greatest magic trick in financial history. It's called regulatory arbitrage, which is a very boring academic phrase for a very exciting criminal concept. Finding a loophole the size of Texas and driving a dump truck full of cash through it. After the global economy melted down in 2008, Congress passed the Dodd-Frank Act. They thumped their chests and told the American public, "We fixed it. We put handcuffs on the big banks." And to be fair, they kind of did. They told the banks they had to keep more cash in the vault and stop making insane speculative bets with your deposit money. The banks, surprisingly, listened. They became boring. They became safe. The politicians declared victory and went home. But here is what they missed. Capital is like a water balloon. If you squeeze it on one side, by making it hard for banks to lend, it doesn't just disappear, it bulges out on the other side. The demand for risky loans didn't vanish just because Citibank wasn't allowed to sign the check anymore. The junkies, the desperate companies needing cash, were still lining up, and the dealers just changed their address. While the regulators were busy inspecting the front door of the banking system, the entire party moved to the back alley. This is where the private equity firms and hedge funds stepped in. They looked at the regulators and said, "Hey, we aren't banks. We don't take deposits from grandma. We take money from sophisticated investors. So your rules don't apply to us." And just like that, the shadow banking empire was born. The risk didn't leave the system. It just went dark. We traded a system of regulated monsters for a system of invisible ghosts. And we patted ourselves on the back for being so smart while the shadow banks quietly picked up the dynamite the big banks were forced to put down. Meet the new masters of the universe. They don't have tellers. They don't have ATMs. And they certainly don't give away free lollipops. You might not know their names, Blackstone, Apollo, Carlyle, KKR. But I promise you, they know yours. In fact, they probably own the apartment you live in, the company that employs you, and the emergency room you'll rush to when you have a heart attack from the stress they caused. These are the giants of private equity, the heavyweights of the shadow banking world. Before 2008, they were just rich guys buying companies, stripping them for parts, and selling them for a profit. Cute, right? But after the banks got handcuffed, these guys became the lenders of last resort for the entire global economy. Here is the difference. A bank takes your $100 deposit and lends it out. The government watches them like a hawk to make sure they can pay you back. These shadow giants, they don't take deposits. They take billions from pension funds, university endowments, and sovereign wealth funds. They take the retirement savings of firefighters and teachers and throw it onto the roulette table of high-risk corporate debt. And because it's investment capital, not deposits, the regulators are effectively blindfolded in the corner, humming loudly so they don't hear anything suspicious. They have gone from niche players to the landlords of capitalism. Blackstone isn't just a firm, it's the largest owner of commercial real estate in the world. Apollo isn't just an investor. They are buying up insurance companies so they can play with the premiums. They are financial shapeshifters, turning themselves into whatever avoids the most taxes and regulations while extracting the maximum amount of cash. And the darkest irony? If you have a pension, you're funding them. Your retirement money is the fuel they use to buy your local hospital, cut the nursing staff to boost margins, and charge you $50 for an aspirin. They have built an empire where they own everything, risk nothing, and you pick up the tab. Financial memory is incredibly short, and financial greed is incredibly creative. If you watched the world burn in 2008, you remember the villain of that story, the CDO, or collateralized debt obligation. That was the toxic sludge of bad mortgages wrapped in a pretty bow and sold as gold. Well, I have bad news for you. The toxic sludge is back, but this time it's wearing a fake mustache and calling itself a CLO, collateralized loan obligation. The bankers didn't learn a damn thing about risk. They just learned how to rename it. Here is the Alchemy 2.0. Instead of bundling up mortgages from strippers in Las Vegas who own 5 houses, the shadow banks are bundling up risky loans to desperate, debt-ridden corporations. They take hundreds of these junk loans that no sane person would touch individually, and throw them into a blender. Then they slice that radioactive smoothie into layers. The top layer gets paid first, so the rating agencies, those useless referees who were asleep at the wheel last time, stamp it OAA and call it safe. It's the exact same magic trick, taking a pile of dog manure, spraying it with perfume, and selling it to pension funds as a bouquet of roses. The volume of this market is terrifying. We are talking about trillions of dollars of corporate debt disguised as safe investments. The demand for these CLOs is insatiable because, in a world where safe government bonds paid 0% interest for years, everyone was starving for yield. The shadow banks said, "Here, eat this. It pays 6% and the rating agency says it's safe." So the insurance companies and the pension funds gorged themselves. They are currently sitting on a mountain of these things, blissfully unaware that the underlying loans are to companies that are barely breathing. The moment the economy stumbles, the moment interest rates stay too high for too long, the bottom layers of that smoothie turn to poison, and the sickness travels up. We re-engineered the exact doomsday machine that blew up the housing market, pointed it at the corporate sector, and pulled the trigger. Welcome to the golden age of private credit. It sounds fancy, doesn't it? Like a VIP lounge at an airport where they serve free champagne. In reality, it's a payday loan store for billion-dollar corporations. Here is how the trap works. Let's say you run a company that is drowning in debt, bleeding cash, and desperate for a lifeline. You walk into a regular bank, a JP Morgan, or a Wells Fargo. They look at your books, laugh in your face, and show you the door. Why? Because the regulators won't let them lend to a walking corpse. But don't worry. The shadow banks are waiting in the parking lot. They welcome you with open arms. "We'll lend you the money," they say. "We don't care about those pesky banking regulations." But there is a catch. The interest rate isn't 5%, it's 10%, 12%, maybe 15%. And it's a floating rate, which is banker speak. For if the Federal Reserve raises rates, your payments go up and you go bankrupt. You sign the deal because you have no choice. You just entered the private credit trap. This market has exploded to over $1.5 trillion. It is the dark matter of the financial universe. We know it's there because it's warping the gravity of the entire economy, but we can't see it. Unlike public markets, where you can look up a bond price on a Bloomberg terminal, these deals are done in secret. There is no ticker tape. There is no daily pricing. A shadow lender can have a portfolio full of loans that are completely worthless, but because they don't have to mark them to market every day, they can pretend everything is fine. They are marking their own homework. It is a mountain of leverage built on handshake deals, non-disclosure agreements, and the delusional hope that nothing will ever go wrong. But things always go wrong, and when this mountain starts to slide, there is no safety net to catch it. Let's step away from the Bloomberg terminals and the spreadsheets for a second. Let's talk about the real world, the one where you actually live. Because the most insidious lie the financial industry ever told is that these complex debt instruments stay on Wall Street. They don't. They land squarely on Main Street, and they hit with the force of a wrecking ball. When shadow banks and private equity firms play their game, the chips on the table are not just dollars. They are your job, your pension, and your home. This is the real-world hostage crisis. Here is the playbook, and it is brutal in its simplicity. A private equity firm spots a decent, boring company, maybe the grocery chain where you buy your milk, or the nursing home where your grandmother lives. They buy it, but they don't buy it with their own money. They buy it with debt, huge amounts of it, and then they slap that debt onto the company's balance sheet. It's like someone stealing your credit card, buying a Ferrari with it, keeping the Ferrari and leaving you with the bill. Suddenly, this healthy company is drowning in interest payments. So, what happens next? The shadow overlords scream efficiency, which is corporate slang for you're fired. They strip the assets. They sell the real estate the company owns and lease it back to them at extortionate rates. They cut staffing to the bone so that one nurse is doing the work of 3. They squeeze every drop of cash out of the business to pay off the shadow lenders and pay themselves massive dividends. If the company survives, it's a hollow shell, a zombie. If it dies, like Toys R Us or Payless Shoes, the workers lose their livelihoods, the community loses a store. But the shadow bankers? They walk away rich, having already extracted their fees. They are not builders. They are strip miners. And it gets worse. When they ran out of companies to gut, they turned to the American dream itself, housing. During the last crisis, they bought tens of thousands of foreclosed homes for pennies on the dollar. Now, they are the world's biggest landlords. You aren't just bidding against other families when you try to buy a house. You are bidding against $1 trillion fund that pays all cash and doesn't care about the inspection. They are turning shelter into a speculative asset class, jacking up rents to service their bondholders, and pricing an entire generation out of ownership. They have turned the economy into a feudal system where they own the land, and you are just a serf lucky enough to pay them for the privilege of existing. For 15 years, Wall Street lived in a fantasy land where gravity didn't exist, money was free, and debt was just a number on a screen that you could roll over forever. It was the longest, wildest party in financial history. But then, the lights flickered, the music stopped, and the police kicked down the door. The era of zero interest rate policy, ZRP, is dead. The Federal Reserve, in a desperate panic to fight inflation, jacked up interest rates at the fastest pace in 40 years. And just like that, the cheap fuel that powered the entire shadow banking engine evaporated. Gravity is back, and it is crushing the players who forgot it existed. You want to see the trigger? Look at the empty office building in your downtown. Commercial real estate is the first domino to fall, and it is a heavy one. The shadow banks lent hundreds of billions of dollars to buy office towers that are now ghost towns because everyone is working from home on Zoom. These buildings are worth a fraction of what they paid for them, but the debt is still there, fully intact, and it's coming due. This is a slow-motion car crash involving trillions of dollars in real estate loans that simply cannot be repaid. Then there are the zombie companies, the businesses we talked about earlier that were barely surviving on cheap debt. They are walking dead. They need to refinance their loans, but instead of borrowing at 4%, they are staring at 9% or 10%. They can't pay it. The math simply doesn't work. The default cycle has begun. We are already seeing the cracks. The big funds, the ones who told you they were liquid, safe, and stable, have started putting up gates. That's financial speak for, you can't have your money back right now. When the investors try to run for the exit and find the doors locked, panic isn't a possibility. It's a guarantee. The trigger has been pulled. We are just waiting for the bullet to hit. So, who catches the falling knife? When the shadow banks crash, when the private credit bubble pops, and the commercial real estate market turns to dust, who pays the bill? If you think the answer is the reckless billionaires who made the bad bets, I admire your optimism, but I pity your naivety. The bill is coming to you. It always comes to you. The genius of the shadow banking system is that they didn't just gamble with their own money. They gambled with the structural pillars of society. They took money from pension funds, insurance companies, and university endowments. If Blackstone or Apollo takes a massive hit, they don't just lose a yacht. The firefighters' pension fund in Ohio loses its solvency. The life insurance policy you've been paying into for 20 years suddenly can't meet its obligations. They have taken the financial security of the middle class hostage. They have strapped themselves to your retirement accounts and said, if we go down, you're coming with us. This forces the hand of the Federal Reserve and the government. They will have no choice. They will look at the carnage and realize that letting the shadow banks fail means letting the pension system collapse. So, they will print the money. They won't call it a bailout this time. That word is too politically toxic. They will call it liquidity support or market stabilization measures. They will invent a boring acronym to hide the crime. But make no mistake, it will be a transfer of wealth from the public purse to the private pockets of the very people who built the bomb. We moved the risk from the banks to the shadows, but the guarantee remains the same. Privatized profits, socialized losses. You are the ultimate insurance policy for a casino you aren't even allowed to enter. This brings us to the ugliest truth of all. The system isn't broken. It was built this way. We are trapped in a doom loop where financial crises are not bugs in the code. They are features. The shadow banking rise wasn't an accident. It was the inevitable result of a world that refuses to let the rich actually lose money. We didn't solve 2008. We just kicked the can down the road, and the can got heavier, more toxic, and harder to kick. The next collapse won't look like the last one. There won't be lines outside Northern Rock or Lehman Brothers employees carrying cardboard boxes. It will be silent. It will happen in the fine print of private credit contracts and the frozen withdrawal screens of real estate funds. But the result will be the same. Wealth will concentrate at the top, pain will concentrate at the bottom, and the cycle will reset. The shadows have swallowed the economy, and until we demand a system where capitalism actually applies to the capitalists, where they are allowed to go broke when they make stupid bets, we are just waiting for the next bomb to go off. 2008 never ended. It just went underground. And now, it's clawing its way back up to the surface.